author of The Thoughtful Investor, joins in today, and you've got to pay attention because he's actually going to be telling us how to go about selecting the stocks which will pay rich rewards. Mr. Maheshwari, thanks so much for joining in. So first things first, when we talk about stock selection, what are the absolutely key parameters that a retail investor needs to watch out for? I mean, what are the 3 or 4 or 5 things that he just can't do without?
First, the retail investor has to get interested in things which he knows. If you're working in a software company and you're buying shares of a power generating unit, or if you're working in a pharmaceutical company and you're buying shares of a consumer company or something else, that's a problem first. You got to buy things that you understand. That's very basic. Secondly, when it comes down to looking at a stock, I think primarily a very simple yardstick would be to buy sector leaders of every sector. And again, you got the return on equity and dividend yield. I mean, a retail investor who doesn't have expertise to actually analyze balance sheets to that extent should go by yield. At least he should buy stocks that are giving him a 1% yield or 1.5% yield, because dividend tells you that profits are for real and nobody pays real money on fake profits. So dividend and taxes, these are the 2 genuine outflows that a company does. So I think focusing on dividends, focusing on sector leaders, and focusing on things that he understands, and focusing on companies that can assure him of secular growth if he can avoid buying cyclicals, because it's very difficult for him to find out what's going to happen on the lead metal exchange, very difficult for him to find out what the government would do. I mean, if crude goes to $10 or crude goes to $100, ONGC will not be allowed to make as much profits as it would have been had it been in private hands. If Coal India isn't able to raise prices, then I mean, it's all very patriotic to say, I want to own Coal India, I want to own NTPC, I want to own ONGC, I want to own IOC, but there's a secret hand that holds you from making too much money there. So if a retail investor can say, okay, I don't want to buy regulated sectors, I don't want to buy cyclicals because I can't understand them, let me see what's left out of me. So these are broad contours under which he can work.
Yeah, I know, actually you make a very valid point in your book when you say that companies that have happy customers will most likely have happy shareholders as well. So does that mean that if I use Britannia products, I mean, not to like be specific to any other company, if I'm using a certain FMCG set of products, is that the company for me to bet on? I mean, what if that company doesn't go anywhere?
Just think about it. What do you do when you wake up? You brush your teeth. You could have bought Colgate 20 years back. You have a bath. You could have bought HUL. You're on the dinner table, dining table, having a breakfast. You could have looked at Nestle. You could have looked at Nescafe. You're looking at a Hero Honda bike outside. You could have looked at Hero Honda. The first time, just think, when was the first time these things happened to you in life? About 20 years back, 25 years back. And all these stocks have gone up 10, 15, 20, not 30 times, but at least 100, 200, 300, 400 times. Asian Paint, somebody's getting his home painted. You're calling your friend on a mobile, Bharti Airtel network. Suddenly you're opening an account with HDFC
Bank. Do I have
Bank.
to keep looking for new sectors? I mean, are these sectors
they will come to you
now?
They will come to you. It's not like hunting for something. You will get it. I mean, it's very difficult to actually explain how you will get it, but the first time you get hooked onto something, look at the product, just go and check whether the company is listed or not. This doesn't mean that you have to buy the stock. This is just the first point of your analysis.
Okay, so if and when I do, decide on a sector or a stock, how do I know which is for the long term and which is for the short or near term, which will get exhausted easily?
While the general theory is that buy stocks for the long term, 80% of India's market isn't fit for long term investing because they consist of either cyclical companies or companies with suspicious management or whatever. So with a cyclical company, you got to get a entry strategy correct and also the exit strategy. But if you buy stocks for a long term, companies which are not cyclical, companies which are not owned by government, where there's an artificial dampener on the kind of profits these companies can make, then you can just buy, sit on them, let them become expensive, let the earnings catch up with price, and you can keep holding on to them.
Okay, so what about a company which currently may not be showing a lot of price action? Should a retail investor still look at it in the hope that in the future it could give returns?
Normally, it is better to buy a little higher after the story has become clearer, rather than just buying a stock and assuming that things would become clearer. So if the price action is not coming and earnings are increasing and the company is increasing sales, it's increasing profits, it's taking market share away from its competitors, it's creating a dominant space for itself in the marketplace, then you can buy it. But if nothing is happening and the price is also there, then it becomes kind of a lottery ticket investing where you just toss the coin up and you say if it comes heads I'm going to hold it or tails I'm not going to hold it. I wouldn't subscribe to that view, because the opportunity cost, which is one of the biggest costs of investing in this market, is very huge. If you buy a stock which doesn't move for 3 years, you got a standard big sized stock like an HDFC Bank which grows 20% every year. So with every passing year, it's like a cricket match where the required run rate keeps increasing, because had you bought that instead of this, then you would have done far better off. So I think I would not subscribe to a view of buying on hope and then waiting something to turn up.
Okay,
Normally.
within the financial metrics